Hello, everyone. Welcome back to my YouTube channel. Today's update. We are diving deep into the intricate mechanisms of the global financial markets, focusing our lens intensely on Southeast Asia, specifically the latest macroeconomic shifts impacting the Vietnamese Dong. In a fiscal landscape that has been characterized by immense volatility, shifting interest rate differentials, and evolving supply chain dynamics, every minor fluctuation in currency valuation tells a story of trade balances, central bank interventions, and broader economic health. Today, we are analyzing the breaking financial reports coming straight from Hanoi, where the State Bank of Vietnam has adjusted its daily reference exchange rate, triggering a series of fascinating movements across major commercial banking institutions and retail currency desks alike. As of the close of the trading session on June 26, 2026, the USD VND exchange rate experienced a notable downward adjustment, falling to precisely 26,300,000. This represents a decrease of 0.08% from the previous trading session. Now, while a fraction of a percent might seem negligible to the casual observer, within the multi-trillion-dollar foreign exchange ecosystem, a move of 0.08% sends immediate ripples through corporate balance sheets, import-export calculations, and sovereign debt portfolios. To truly understand what is happening with the Vietnamese Dong, we have to zoom out and look at the broader temporal horizons, tracing how this currency has performed over both the short and the long term. When we look at the data over the past month, the Vietnamese Dong has actually demonstrated a degree of resilient strength, appreciating by 0.13% against the greenback. This short-term rally indicates a period of stabilization, potentially driven by robust foreign direct investment inflows, a positive trade surplus in the manufacturing sector, or strategic liquidity management by the central bank. However, when we contrast this monthly strength against the broader macroeconomic trajectory of the past year, a completely different narrative emerges. Over the last 12 months, the Vietnamese Dong is actually down by 0.79% against the United States dollar. This year-over-year depreciation highlights the persistent structural pressures that emerging market currencies have faced globally, particularly as the United States Federal Reserve maintains its own complex monetary policy stance, which has kept the dollar relatively strong on the global stage. This push and pull dynamic between short-term appreciation and long-term depreciation underscores the delicate tightrope that Vietnamese fiscal policymakers must walk as they attempt to foster economic growth without triggering runaway inflation or capital flight. Looking at how this macro data translates to the ground level, let us take a closer look at the actual retail and corporate trading boards at the country's premier banking institutions. The two banking titans of Vietnam, Vietcombank and the Bank for Investment and Development of Vietnam, or BIDV, have updated their official listings to reflect these broader systemic shifts. Both financial institutions listed their buying rate for the US dollar at 26,127 VND per USD, while their selling rate was firmly established at 26,407 VND per USD. Interestingly, despite the slight drop in the overall daily reference exchange rate, both the buying and selling rates at these major commercial banks actually ticked up by 3 VND from the previous session. This subtle divergence between the official central bank benchmark and the commercial bank retail rates reveals a tightening of the trading spread and reflects the real-time liquidity demands of commercial entities operating within the Vietnamese market. For businesses looking to liquidate their dollar holdings to pay for local labor and raw materials, they are getting slightly more Dong per dollar than yesterday morning. Whereas importers looking to acquire greenbacks to settle international invoices are facing a marginally higher cost. This spread between the buying rate of 26,127 and the selling rate of 26,407 also represents the classic banking margin, a critical metric for assessing market volatility and transactional liquidity in the region. To fully dissect these figures, we must ground ourselves in the fundamental mechanics of the foreign exchange market itself, specifically understanding what these rates represent conceptually. When we discuss the USD VND spot exchange rate, we are referencing a very specific financial metric. The spot exchange rate specifies exactly how much one currency, in this case the United States dollar, is currently worth in terms of the other currency, the Vietnamese Dong, for immediate transaction. Essentially, it is the live market price that dictates the value of an instantaneous swap. If you walk into a banking hall today or execute a digital wire transfer at this very moment, the spot rate is the benchmark governing that capital movement. However, the financial architecture of international trade requires tools that extend far beyond immediate transactions. This is where the critical distinction between the spot exchange rate and the forward exchange rate comes into play. While the USD VND spot exchange rate is quoted and exchanged on the exact same day, the USD VND forward rate is fundamentally different. The forward rate is quoted today, locking in a binding contractual price, but it is explicitly designed for delivery and payment on a specific, predetermined future date. This contractual tool is absolutely vital for corporations engaged in multinational trade, as it allows them to mitigate foreign exchange risk. For instance, a major electronics manufacturer operating out of a high-tech park in Ho Chi Minh City might know that they need to import specialized components from overseas in 6 months, requiring a massive payment in US dollars. By utilizing the forward market, they can lock in an exchange rate today, shielding their profit margins from any sudden, adverse devaluations of the dong or unexpected surges in the dollar over the coming half year. When we look deeply into the structural health of the Vietnamese economy through the lens of this 26,300 valuation, we have to consider the strategic intent of the State Bank of Vietnam. The central bank utilizes a managed floating exchange rate regime, meaning they allow market forces of supply and demand to dictate the general direction of the currency. But they establish a daily reference rate to prevent wild, destabilizing, speculative swings. By steering the daily reference rate in a manner that allowed the spot rate to soften slightly by 0.08%. In this session, the central bank may be subtly calibrating the competitiveness of Vietnamese exports. Vietnam's economic engine is intensely export-driven, relying heavily on the shipment of smartphones, garments, footwear, agricultural products, and heavy electronics to primary consumer markets in North America, Europe, and across Asia. A marginally weaker currency over a 12-month horizon, as evidenced by that 0.79% depreciation, can actually serve as a powerful economic catalyst. It makes Vietnamese manufactured goods cheaper and highly attractive for foreign buyers holding US dollars. Conversely, the central bank must remain incredibly vigilant, because an overly weak dong increases the domestic cost of imported necessities, such as refined petroleum, specialized machinery, and chemical inputs, which can quickly feed back into domestic consumer price inflation. This delicate balancing act is further complicated by the realities of foreign direct investment, which remains a cornerstone of Vietnam's long-term developmental blueprint. Foreign corporations looking to build massive manufacturing plants or invest in domestic infrastructure projects must convert billions of dollars into dong to clear land, construct facilities, and pay local engineering teams. The fact that the dong has managed to strengthen by 0.13% over the past month indicates that inflows of foreign capital may be robust, creating a localized demand for the dong that temporarily drives its value upward. When commercial giants like Vietcombank and BIDV adjust their spreads and raise their baseline rates by 3 VND, it signals to the market that corporate treasury demand for hard currency remains highly active. These micro-adjustments of a few dong here and there are the heartbeat of the commercial banking sector, serving as an indicator of how comfortably banks are holding dollar reserves versus how aggressively they need to price their instruments to attract foreign currency deposits. As we look toward the final quarters of 2026, market participants, international investors, and everyday citizens will continue to monitor these metrics with absolute precision. The slight 0.08% dip in the USD VND spot rate to 36,300.0000 serves as a powerful reminder of how interconnected the local Vietnamese marketplace is with the grand macro-financial architectures of the world. Whether you are an online entrepreneur managing an international e-commerce store, an investor looking at emerging market exchange-traded funds, or someone tracking currency trends for personal remittances, understanding the variance between spot rates for immediate execution and forward rates for future risk management is essential. The State Bank of Vietnam will undoubtedly continue its active monitoring, adjusting the daily reference rate as global geopolitical landscapes evolve and trade parameters shift. We will be right here, keeping an exceptionally close eye on every single update, tracking the raw numbers, the commercial banking spreads, and the profound policy shifts that dictate the value of the Vietnamese Dong on the global stage. Thank you so much for joining me for today's extensive financial market breakdown. Make sure to stay tuned as we continue to track the global economy, unpack complex monetary dynamics, and bring you the vital financial updates you need to stay ahead of the curve. See you in the next update.